Hello, have a pleasant day. Today's class is Methods of Valuation of Shares. I am Dr. Srimati from Dr. Ambedkar Global Law Institute, Tirupati. Let us start the different methods of valuation of shares. So here we are naming the four methods. The first one is net assets method, yield method or market value method, earning capacity valuation method, and fourth one is dual fair value method. That is dual method or fair value method. Only we are going to see the theory and formulas in this video. So we are renaming those names as like this. So any of the name they may ask you, but you have to put only net assets method, formulas, everything. And yield method equal to weak. Otherwise it can be called it as market value method, earning capacity method or dividend yield method. So this method is not for your syllabus. And fair value method or dual method or average of assets backing and yield method. This is how it can be called, and it can be asked in your question papers. Let us start with the first one, net assets method or intrinsic value method. So here the investors are mostly influenced by the security. Suppose an initial investor, the new investor means they will take care about the security. So here they want to find out how much the assets are covered with the value of the shares. And then for finding out the real value of the assets covered, that should be considered. How much the assets are covered for the each shares. And then non-trading assets, if anything is there by the company, that should also be included in the market price. And here intrinsic value of equity shares equal to the total funds which is available for equity shareholders divided by number of equity shares. So here the number of equity shares means both the fully paid and partly paid of shares. So first we want to find out, this is the formula. So we want to find out the values, total funds which is available for equity shareholders. That means whatever the assets available less paid up value of preference shares, and then whatever we get that is available for equity shareholders. Determination of value of net assets. How to find out the net asset means the net asset equal to realizable value of asset minus outside liability. Since it has been assumed that it has been the company goes to liquidation, so we have to make all the assets realized, that is sold in a market, and whatever we get, and then outside liabilities which is to be payable, or else we can get it as, or we can name it as net asset equal to revalued asset minus revalued liabilities, or else it can be arrived like this: net asset equal to equity share capital plus preference share capital, reserves and surplus, then profit on revaluation of assets including goodwill, and then we can reduce these items, then we can get easily the net asset. The determination of value of net asset again. So this is the way how it can be calculated with the help of a format, pro forma. The funds which is available to equity shareholder means net asset of the business we have to take minus the preference share capital, and then preference shares arrear of dividend anything is available, then shares in the reserves and surplus, then we will get a net asset of the business. The shares in case of participating preference shares, anything available, then you can get it. And then number of equity shares means shareholders, how many shares available in a company. That is, suppose if any shares which is having an uncalled amount, then that amount also be taken into account and it has been termed as fully paid up shares. And then whether the both fully paid up or partly paid up equity shares, the amount of uncalled and partly paid up shares, called it as a notional call, again that should be added back to. So this total amount will be divided by the total number of equity shares for both fully paid up and partly paid up. So total net assets, the funds which is available to equity shareholders before calling notional calls, we have to take that amount and then add notional calls on partly paid up shares, and then you can find out total funds available to equity shareholders. And the next method is yield method, or else we can name it as market value method. In this method, future maintainable profit is estimated by reference to the past performance. So this has been adjusted in eliminating non-recurring incomes and deducting income tax, anything is there, and making allocation of reserves and preference dividend. This adjusted profit is capitalized at the normal rate of return, which has been received in similar type of business. And how to get it? Expected rate of return that should be calculated. Profit available to equity shareholders divided by total paid up equity share capital multiplied with 100. So basing on expected rate of return, the value of the share can be calculated. Value of each share equal to expected rate of return divided by normal rate of return multiplied with the paid up value of each share, so that you can get it easily. And this is about earning capacity method. So when the yield method fails about taking care about the financial stability and the strength, so here it's because that yield method considers only the rate of dividend rather than the capacity of earning. So this method, earning capacity method, comes. So this valuation depends on the comparison of the company's earning capacity with the normal rate of return on capital employed. So how to find out? Since this is about an accumulated profit is likely to be distributed sooner or later in the form of issue of bonus shares. So the market price is based on earnings of the company rather than the dividend declared. This is usually accepted. And then this method relates to the value of the shares to the real efficiency of the company as measured by profitability of the company. So value of share equal to the rate of earnings divided by normal rate of return multiplied with paid up value of shares. So market value of the shares, the dividend per share divided by normal rate of dividend. Then fair value method, it is nothing but the average of intrinsic value method plus yield method. So when one cannot find out the exact value of the share under any of this method, then they will prefer this fair value method or dual method by averaging it. So fair value equal to intrinsic value, that is net asset method plus yield value divided by 2. Hope you understood. Until the next, it's bye from Srimati. Thank you.